Today I want to talk about two of my favorite topics, real estate and taxes. And I'll start with taxes. And I think this is going to be hopefully relevant to you guys. I don't know the entire audience. I don't know your circumstances. So obviously it will be circumstantial, how it relates to you, but I'll try to make it as relatable as possible. And feel free to ask me questions as I go along or ask in the Q&A. So a little bit about me. I went to Wharton, did the whole economics and investment banking thing, with like any other person who went to Wharton. But then I did a 180 degree, went to Peace Corps, and then did a bit of analytics and joined Apple. And most recently, I was leading data science at Siri. And most recently, I have founded Tozy Capital with $100 million of assets under management. But throughout this whole time, I have been a real estate investor. And through that 12 years of experience, I really found many different strategies that weren't talked about in the corporate world. And during this whole time, I've also been a taxpayer, and I've also been trying to figure out what's the best way to reduce your tax burden. I want to preface that I am not a tax professional. I talked to many tax professionals. I literally talked to one this morning. But obviously consult your CPA for final guidance and whatnot. This is just my perspective on things. I do want to talk about something a little bit topical, the Joe Biden tax plan and his proposals, at least as they were during the campaign. Obviously, people's campaigns and their politics aren't always aligned. So just preface that. This is a list of potential tax changes and its respective impact on tax revenue. I don't need to talk about the tax revenue impact. I want to talk about the tax changes. And I'll highlight 5 of these in subsequent slides. But in general, the theme is we will raise taxes on the wealthiest and we will give subsidies to the poorest. General theme. And I'm not making any political assumptions. I'm just saying how this is interpreted. So one thing that we are seeing is a potential raising of the top individual tax rate. I don't need to say any of these numbers, but the raising the top individual tax rate is really a reversion to where it was before, although it does retain the lower tax rates for the smaller folks. Now, just as a word for warning or notice that the current law is not necessarily a permanent law. The individual tax changes are not permanent, unlike the corporate taxes. They are temporary for, I believe, another 7 years or 10 years, at which point I'm sure Congress will move quickly on changing that. Another proposal that could be very impactful for you guys is FICA tax. Currently, it stops at 6.2%. Essentially, what the proposed law would be to raise it. You can see the other impacts here are the corporate tax rate moving up, the top capital gains rate moving up, estate tax getting a bit heavier, as well as pass-through income. Some of these are still below what they were 4 years ago, but they are still higher than now. And they're generally targeted towards sort of the richest of those who can potentially afford it. At least that's what Democrats think. The itemized deduction changes are also a big thing. And for those who are living in California, this could be a relief. Before, there was no state and local state income limitation, which means that if you bought a house for more than $1 million, you could have deducted that whole mortgage interest. Now you cannot, right? If you're buying a house in California or any high property value state with high property taxes, you're probably not being able to deduct your entire mortgage interest, which is one of the reasons why potentially it was easier to afford things here versus rent. So that potentially could be eliminated, which is favorable to the Democrats in this case. And there are a few other itemized deductions that could be changed as well. In addition, there are tax credits that the Biden tax law is potentially proposing, with the most impactful of these being the child dependent care and child tax credit. I did just have a child 2 weeks ago, so if this goes through, I will overall owe more money. Still, every little bit helps. So that is like a very brief summary of the Joe Biden tax plan. And in my last presentation, I had a CPA present this with me, and she was able to talk in more detail. But I am also a pragmatist. I don't just think that these things will happen. I follow politics a lot, and I have friends in Capitol Hill who are lobbyists, and I talk to them a lot about these things. And I do not believe that Biden's tax plan will happen. If it happens at all, it won't happen anytime soon. First of all, the Georgia runoff still looming and still showing unfavorable for Democrats. It's just Democrats do not have something to vote against at this point. And they do very poorly in off-cycle elections. Even if they won both seats, it'll be 50-50 edge in the Senate. What did the Democrats do with 60-seat majority, supermajority in the Senate? They passed a neutered Obamacare when they wanted a lot more, and they didn't pass much of anything else in 8 years. So if you think that the Democrats are going to pass anything with a super thin minority, a majority in the House, as they have raised 4 sitting congressmen, which reduces their margins to nearly zero in the House of Representatives, but in a 50-50 House Senate, where Joe Manchin and West Virginia is still a Democratic but very fiscally conservative senator. I do not believe this would be realistic to pass until that changes. So at the very latest, 2022, really 2023. Major tax laws do not get changed as quickly as 3 to 4 years later. That just does not happen. Major laws in general do not get changed that quickly. And the stimulus, while it just passed today, is not a big part. It's going to be the biggest priority for the Biden administration. And it'll be a bigger stimulus. It'll be a bigger priority. And then there'll be climate change and justice issues, as well as other issues that the Democrats would probably have. It's not worth it to spend political capital on tax reform when people are trying to revive the economy. So that's my whole spiel on the Biden tax plan. CFOs also feel the same way. This poll is done in December 2nd, where they just don't believe, or they don't feel confident that Biden will raise the corporate taxes. And this is reflected in the recent stock market run-up. That is, the market is essentially pricing in the sort of stagnation that will happen in the legislative plans. The laws will not change much. So that's really the political analysis for today. I'm going to transition into talking about taxes and how potentially real estate can help, and how I've used real estate to pay less taxes. And I really like to talk about it as in how do I keep more of my earnings or your earnings. You've earned this. Let's try to minimize your taxes. And if anyone's seen these slides before or came to one of the presentations, I've talked about the same thing. But when it's about your taxes, it's about the facts. You have to rearrange the facts. One of the ways to rearrange facts is moving now to later. So that's the concept of deferrals. And I'll talk about the rest of this time, talk about deferrals and talk about depreciation, talk about tender exchange and opportunity zones. And these 3 facets of deferrals with in tandem with real estate. It's a great way and one of the best ways to defer and eliminate your taxes. And that's how a lot of real estate investors do it. So I want to start by talking about deferrals. And I think this is somewhat abstract topic when people think about it. People don't really have a good sense of what opportunity cost is. It's hard to imagine what opportunity cost is because you only do one thing. You can't really think about the other thing you could have done. So let me try to illustrate some of this for you. If you were going to invest $100,000 into a real estate investment, and that real estate investment yielded 12% a year, and you were able to compound it, that 12% returns, over 10 years, you would have made $310,000 from your $100,000 investment. If you deferred those taxes, you essentially would have to pay that $100,000 at the end of 10 years. That's a deferral. And the deferral is on an absolute basis, not on a percentage basis. When you defer 401k, you're essentially not paying your tax rate going in, but you're paying your tax rate going out on the profits that you made. Now, if you made a lot of profits, which includes the income that you put into it, then it's not really going to be an absolute value number. It's going to be a bigger percentage number. And of course, tax rates could change in the future. One thing I want to highlight here is that if you defer things and you invest the money that you deferred, you're able to take a lot of benefit. Another, when you look at depreciation, essentially is a deferral of taxes. If you're able to essentially defer through depreciation, you could save $37,000 on your initial investment because you would have paid taxes on it. And then you owe $25,000 because that depreciation benefit gets recaptured at 25% rate. So not only are you paying the same amount in the future, actually not the same amount, you on the same amount of taxes, you're also converting it from ordinary income to long-term capital gains. So a conversion as well as deferral. Another thing that I think everyone should think about is how inflation erodes the future value of your money. This is why it's pretty highly ill-advised to have money, cash sitting in your bank account sitting too long. That's why there are negative interest yields in other parts of the world. That's essentially the federal government, the central planners, essentially incentivizing money to be invested, which means that money invested makes asset prices go up, as you can see by real estate prices, as well as stock prices. This creates inflation. Inflation reduces the purchasing power of your dollar, and an inflation rate of 2%, you essentially would owe less in the future because the same amount you owe is just worth less. This is also why I love long-term debt. Give me all the 30-year fixed income, APRs as you want, because I would just finally owe less in the future. Because if I think about what $100,000 could buy 30 years from now, I could probably buy a house in Silicon Valley. And of course, now that's not even a down payment, maybe around 5%. And of course, inflation at 2% is conservative. It likely will be more than 3. And those two factors really makes it, the concept of deferral is really powerful. So what makes depreciation stronger or weaker? And one thing I want to highlight here is when you buy property, your non-land value of your property is what you can depreciate. So you bought a house for $1 million and the property, the land is worth $500,000, 50%. Then you can only depreciate $500,000 of value. If the land is worth less, your money is worth more, or you can get more depreciation. So I love investing in low land value areas like Kansas City because I can claim a low land value of 5%. This is an amazing number here because I can now have, instead of $12,000 in yearly losses, depreciation paper losses, I can get $17,000 for the same amount of money I put in. That's more deferrals I can get. So okay, one of my slides is a little bit off. So depreciation, one thing I want to highlight here is an example of what happens when you invest your money in any real estate investment. If, except for REITs, they do not give K1s depreciation. If you put $100,000 down, you get 12% a year for 5 years. This is an example. At the end, you get a little bit of chunk of return back as well. In the same amount of time, though, you would have gotten $12,000 of losses every year because of the depreciation. That means that your $12,000 of gains that you would have actually made that would have gone to your bank account that you could have spent would, as a paper loss, show 0 on the K1 filing when you are able to file your taxes. So your $12,000 become essentially tax-free or tax-deferred because it's depreciation. It gets recaptured in the future. So that's how depreciation works. That's why if you invest in, for example, a real estate investment like what we do at Tozy Capital, or just buy one yourself that has significant cash flow and low land value, your rents, if they're generating 12%, hopefully they're generating double digits, will be tax-free. A 12% cash flow relative to a taxable income is 17%. So you have to earn 17% on like an S&P 500 that also would have to pay money because you're not getting cash flow, right? You can't compound it. You're letting it appreciate and you can't really get it out until you sell it. So it has to be nearly 20%. Of course, the market has done that. So congratulations for those who have been in the market. So then I go back to depreciation. That's one of my slides was a little off. I talked about that. So land value is a big factor of leverage. So the higher the land value, the worse your depreciation benefits. The higher the leverage, the lower the leverage, the lower the depreciation benefits as well. Because when you buy property, banks do not participate in depreciation. I'll say that again. If you buy property and you put 25% of the land of the purchase price, and the land value was 20%, that means 80% of the purchase price can be depreciated. And you put 25%. The other 75% comes from the bank. The bank does not share in that depreciation benefit. You get the full amount. So you get an outsized version of what you could have gotten if you paid cash directly without leverage. So I buy for cash flow because that allows me to have higher leverage because those banks would need typically high cash flow assets to lend safely. So this is why when I invest in, in places like Kansas City, I'm able to get the highest leverage and the lowest land value and get the highest tax benefits. Of course, there are other pros and cons to both of these in terms of leverage, but in terms of getting a discount on my investment, in terms of being able to pay less taxes now and pay less total taxes in the future, is a big benefit.
So Ang, I got a question there. So the magic of the strategy, I know a lot of people in here are quiet tonight, but the magic of the strategy is that you're finding an area with very low land value, 5%. So then you got the other 95% that you could depreciate, but then you're also getting very high leverage at 80%. So all that allows you to depreciate a lot. Like that's like a super nugget right there that I feel like maybe some people overlooked, or is that right?
Yeah, if you were able to buy a property with 0% land value and 99% leverage, you essentially get maybe a 10-to-1 benefit in terms of depreciation, paper losses that can offset your passive income for your cost basis of investment. So if you get the opposite, if you have to pay all cash, if your land value is very high, depreciation won't necessarily be a factor in how you tax plan.
Okay, interesting. So we do have some questions to follow up here as well. So Phelan asks, hey, can you please let us know what will happen when the book value is fully depreciated?
When the book value is fully depreciated, it goes to 0 and you should sell and tender on exchange and recycle your depreciation. This is why most people
I
sell.
see. That makes a lot of sense. Sorry, I interrupted you.
Yeah, it's okay. I was going to say, Sometimes I'll ask, like, why when I buy a property from somebody, I ask, so why are you selling? Is that, no more depreciation? Oh yeah, I get it. They're essentially, what they're doing is they're taking their depreciation, and they would have, if they sold it, your book value would be zero or as low as possible. You now owe a significant amount of capital gains. You buy something much bigger. You transfer the book value, your cost value, into the next asset, and hopefully now it's more than zero, and then you can depreciate that to zero, and then buy a bigger thing the next time around.
Interesting. Ross asks, who determines the land value?
There are generally accepted studies through the appraisal reports that does that. You can negotiate that within bounds of 5+%. So generally, there's generally accepted appraisal studies, and Kansas City is generally 5 to 10%. Los Angeles is like 50 to 70%. San Francisco can be as high as 80%.
That's interesting.
Yes. I mean, you're buying land in some areas for the land. You're buying land in some areas for the building. So pros and cons of each. Another tip and trick that people have been using and is very popular because of the 2017 Jobs Act, or the Trump tax cut, is cost segregation and bonus depreciation. So you might have heard of this, but essentially it's an engineering study where you pay a firm to take bonus depreciation of categories that could be depreciated within 5, 7, and 15 years, rather than the conventional 27 and a half year. And I'll highlight what that means. But for anybody who bought a property since 1986, you could retroactively go back and do the cost seg on the building. So that could be, I see there's a question. Okay, you're in that.
Yeah. So Seth asked a question related to this. He asked, if there is a cost segregation and the land value is high at San Francisco, but you can't take the depreciation because there's not enough passive income to offset it, can you elaborate on that a little bit more?
Yes. If you can't take the depreciation to offset passive income because you don't have enough passive income, then you essentially have a paper loss that you can carry forward. So imagine investing in a real estate deal, putting $100,000 in. You put 60,000, you get $60,000 loss in the first year, and you got $10,000 gain. So net, you would have a paper loss of $50,000. You would have an actual gain of 10,000, but you have paper loss of 50,000. You aren't able to use a full 60,000, only 10,000 of it. And with that extra 50,000, you take it to the next tax year. And ideally, you dwindle it a little bit more because you're making more income, passive income, and you can keep doing that. And that's a way that people can use. If you're not doing technical exchange, you could sell something and buy something bigger without doing exchange, and essentially have a lot of losses being developed when you made a lot of gains in the same calendar year. All right, so I'll move along. I want to highlight in a very detailed example here a cost seg study that I did recently off a $6 million building. And the building without cost segregation study would have yielded me $550,000, $549,000 of depreciation value or losses. With the cost seg study, I'm able to take 1.5, 1.6 million. So 3 times the benefit in the first 5 years. Really, a lot of it's in the first year. So there's a lot of numbers here, but the net of it is you're essentially getting more losses earlier. And if you have a lot of gains, you can defer those to later. You're essentially pulling stuff forward, pulling stuff from the future to the present. And this is what it looks like. If you see the first column, depreciation without cost seg, you would have normally gotten $109,000 of losses every year, straight line, because we bought in half year. with the cost tech study done, you get a ton of big chunk of it in the first year, 1.28 million of it, and then the rest is taken later. So you get less in the subsequent years. Now, if you held it on for 27 and a half years each case, it doesn't really matter. You get the same amount of depreciation benefits. You only get it earlier, which is still a great thing. But if you aren't able to use it the whole time or upfront, then it's not really that useful. But most people actually then sell it within 5 years and get a huge net benefit relative to if you haven't done it. This does apply for residential houses. This applies for any property that you can depreciate. And the cost usually could be as low as $1,500 to $5,500. If you bought something in California, I'm assuming most people are California, that had land value of 50%. I think it makes sense to do a cost seg study on something. The purchase price is around 750,000, maybe 800,000. Anything less, the cost is a bit too prohibitive. Unless you get for $1,500, then 500,000 is probably a good number. But remember, this is only really about pulling losses forward so that you can defer taxes. We talk about the benefit of the deferral. So I want to highlight that the bonus depreciation benefit would be more significant because you're basically pulling losses forward. So in the previous example, I talked about $12,000 in straight line losses, and I would have essentially paid zero taxable income. In the case that this is the only investment, this is the only passive income source I have, this doesn't really matter. It's really matters if you have a lot more investments that that is earning you money, that you don't have enough losses to offset, that you can now take a lot of these upfront losses to offset those other things. And then here's a little bit of eye chart to tell you what classifies as bonus depreciation. It's really interior stuff like telephone systems, security cameras, lights, sound systems, etc., cabinetry. And then the buildings really can't bonus depreciate.
So, and we got some questions here, if I could ask. Michael asked, he bought a house a couple of years ago. Can we still change the land value ratio to a lower value, for example, 50 to 20%?
I think if you change it that much, it would probably cause a flag. If you change it within 5%, maybe not. I don't know how it would work if you changed it after the fact. Because you essentially you would have to predefine the depreciable value upfront in the first year when you bought it, and then that's the value that you depreciate going forward. So I don't think you can do that. Okay, so what can you depreciate? What can't you? You can depreciate any buildings that you rent for income, and if you live in it, you cannot depreciate it. But if you live in it and then you rent out an ADU or a room or a few rooms, then you can depreciate it. If you rent it out to yourself, you could as well. Land, you can't depreciate. Stocks or art, you can't depreciate. Vehicles, you can. So if you buy a Tesla Model X or anything over 6,000 pounds, there's actually like vehicles that are specifically built to be 6,000 pounds to take advantage of the tax code, where you can buy it and then take the whole thing as the depreciation, 100% write off. It's a good way to get 37% off your next vehicle if you owe that much taxes. So when you depreciate things, it's all about owning stuff in the future. One way that real estate investors like myself defer taxes is doing 1031 exchange. Some of you guys are probably familiar with 1031 exchanges, but essentially it's using an income producing property, right? It has to be income producing to then identify three properties within 45 days after close of escrow, and then complete that transaction within 180 days. that allows you to essentially defer the capital gains and the depreciation recapture, which I talked about earlier as capital gains, to the future. So when you invest in a rental property, you can cash flow, you can take depreciation to offset those taxes, and then you can sell it and then get more depreciation in the future. That's a great cycle because you're now stacking up depreciation again and again and again. I could potentially buy a property, sell it to K in 2 years. He'll sell it back to me in 2 years. I sell it back to him in 2 years, and we'll keep getting more losses. It's great. We'll never pay taxes ever again. That's what you probably should do. I think there's probably some restrictions around it. I don't think that's the spirit of the law. So when you invest in property and then you tender an exchange, it's all about deferring to the future. But when you are able to set up correctly and when you pass away, all these losses that you've accumulated, all these cost basis that has dropped down to zero gets adjusted to fair market value. That fair market value now reduces all taxes to your heirs. So that's a great way to essentially have gone throughout the whole life without paying any taxes. I see Ryan asked a simple question on the 6K pounds. It's 6K, 6,000 pounds, not 10,000 pounds. So the last topic is really about opportunity zones. And this is a really interesting, opportunity that came out from the 2017 Jobs Act, where Sean Parker was instrumental in lobbying for it, and presented the first time where you could defer and reduce your capital gains taxes on your sales stocks ever, except for DSTs. That's harder to do. So when Sean Parker then lobbied for it, that was a pretty good investment. A lot of Facebook stock. This is the opportunity zone map. Every state has one, and it's dictated by the state governments. There's three really big benefits of investing in opportunity zones. The deferral. So if you had gains from this year, say you sold stock just now, and you would have a cost basis of $100,000, but your profits is $400,000. Maybe you had Tesla stock or something. You would have typically have paid long-term capital gains or short-term, depending on that $400,000. Instead, invest the full $400,000 and defer the taxes you would owe to the future date of December 31st, 2026. So 6 years in the future. At that point, you would pay those taxes at 10% less. So remember, deferral and reduction, and then all future capital gains. This old capital gains that you essentially get to defer and get essentially a discount on your investment, and new capital gains that you have created from the asset itself or depreciation recapture that now gets eliminated from having to pay taxes if you hold it for 10 years. And this qualifies for sale of business, short-term or long-term, and real estate. So if you miss your tender exchange window, you can still do an opportunity zone. And I want to highlight this one interesting note from the CARES Act, Notice 2020-39. The net of it is if you sold stock as far back as October 5th, 2019, and you pay those taxes ready, or you sold stock in January, typically you would have 180 days from when you sold those stock or sold any kind of capital gain stuff. You would have 180 days to then invest into QOZF or qualified opposite zone fund. With this provision, it allows you an extended window. If you invest before the end of the year, you can now defer your gains from as far back as last year, file an amendment, get those taxes back, and pay it in the future. And an opportunity zone example here is essentially you get a 20% discount if your long-term capital gains is 20% on your investment, and you can compound it every year, and then you owe 10% less, and then you get all the capital gains that you have created gets eliminated. There's a lot of numbers here. I'll just say repeat you reduce your taxes now, you can invest essentially at a discount. You'd pay less in the future on an absolute level, less as well as on a monetary and deferral level. And then all future capital gains from that property investment gets eliminated. And if you're able to also get real estate professional status, and this is something that I have done for myself and for my wife, you're also able to turn all those passive losses into active losses. Why does that matter? If you aren't able to do this, you can only take all those juicy depreciation benefits that you created for yourself through all these examples I've told you about, and only wiped out your passive income. And hopefully you've got significant passive income, but now it's all tax free. If you're able to get real estate professional status, you can convert all your passive losses into active losses. And now your active losses can be reduced to zero as well. And you would pay potentially zero in taxes. So I'll end with this. 90% of all millionaires become so through owning real estate. More money has been made in real estate than in all industrial investments combined. And this was said when millionaires were, a big deal, and this is still the case, even in the Valley. And Donald Trump said this in the first presidential debates, and I said that same thing when I failed my taxes. And I talk about these tactics from a personal level. I've taken these tactics myself. I do it myself because I am very interested in reducing my taxes and deferring my taxes. I'm able to make quite a bit of money from my income and get a lot of losses and then pay zero in tax for income. So that's the whole presentation. Let me know if you have any questions.
Hey, thank you, Ang, man. That's it's always interesting for me to watch it and listen. I actually have some questions myself. So when you were performing analysis, I guess maybe across the nation and evaluating different commercial real estate out there, how did you come to Kansas City in the end with the lowest land value? Did you look at like other pockets in the nation as well?
I wasn't optimizing for lowest land value. I was optimizing for value. Part of value is having low land value. Because when you have high value of land generally is not a productive asset. So the buildings generally can produce rents and you can get cash flow. I buy for cash flow and I buy for safety as well. Buying real estate, for me, I look at three major decision points. Population growth, job growth, and crime decreasing. If those three things are happening, fundamentally, real estate prices go up. Real estate prices go up because rents go up. Rents go up because more people want to live there and there's less buildings available. And Kansas City had all those metrics, but so did Austin. So did a lot of other cities that were also booming, like in Texas or Florida, but they were also relatively expensive. And so you gotta really keep in mind that you want to buy with good fundamentals, but you want to buy for good value.
Interesting. Thank you. We have a question from Sandra here. Can you explain passive losses versus active losses?
Yeah. So passive losses. Well, let me take a step back. There's three types of income. Active income. This is your W-2 income. This is potentially selling, day trading stocks. And then there's portfolio income, and that's sell stocks, capital gains from stocks. And then there's passive income, which is from businesses, K1s usually, and real estate, primary real estate. Having real estate passive income, essentially, it's all passive income, and then passive losses, depreciation. Active losses, essentially losing money from a business venture.
Got it. Question from Grove here. Has COVID-19 been affected on your income in any way?
I mean, I left my job at Apple earlier this year, mostly because I thought that real estate was a much better strategy. I think from my income from real estate, it has not had a major impact. And in fact, one thing that I've seen is with the prices or financing being so much cheaper, I'm able to refinance and get much lower cost of capital and get better net cash flow. So that's why, at least for me, 2020 has been a pretty good year.
So another question here is, where can we look for the list of losses that we can use to our advantage to our taxes? Any books or sites you recommend?
After this, I'll send everybody a pamphlet on really tips and tricks on taxes. I think there's 67 tips that I've been advised on, and I think they're be pretty cool for you to use. A lot of them are like, obviously buying an electric car, having child. It's not probably not going to be that net profitable, but paying your child $12,000 a year is a way to reduce your taxes. And of course, all these other real estate stuff.
Okay. So let's see. Anyone has any other questions that we could ask Ang? Of course, don't be shy. Let's make it a little interactive tonight. We'll take any question. How do you identify properties? I'm curious to know that too.
At this point, we have a pretty sophisticated schema on how to identify properties. There's ways to identify properties, but then there's ways to identify available properties and not negotiate. That's two separate things. Oftentimes, you really have to identify properties that are in the path of progress, essentially places that will grow with predictability because you've seen the corresponding areas grow. You just need to rate. If you bought a property right in next to Apple Park 3 years ago or 4 years ago, when you knew that Apple Park was being developed, and you just waited 3-4 years, that's a part of progress. You know that's going to grow in value. So that's what we also do in other cities outside the Bay Area.
Awesome, thank you. Shoot, any other questions? I want to start thinking of questions
then. Let's see. There's a few questions on the Q&A, but I have no experience in real estate. Wanted to invest $500K today. How would you invest in that? Depends on where you live. Depends on what you want to do. If you want to invest yourself, buy property, I would probably say that is very hard to do yourself. I would probably want to trust an expert, right? You get a fund manager to help you manage your funds. You get a asset manager like Tozy Capital to help buy real estate for you. That's essentially what we do here at Tozy Capital. We buy assets, real estate that I love, that I invest in, that gets a lot of cash flow and depreciation. And then we offer that to investors to co-invest with us. And so if you had $500,000 or whatever money that you had and you wanted to invest and get 12%, a good way would be to reach out to us and we can see we're a good fit, see if you like any of our opportunities that have all these benefits that I listed out, and see if you can take advantage of the great cash flow, the passive income, because this would be truly passive. And you still get a K1, which would mean that you get all the tax benefits as if you were doing it yourself.
Okay, guys, so I do apologize. My questions weren't moving, so that's why I didn't see any questions, but we got another one here. Can you 1031 exchange a property into an opportunity zone investment?
Yes, you can 1031 exchange property into an opportunity zone investment. It is slightly redundant, but it's actually, you don't have, I mean, you can do it. When you 1031 exchange into an opportunity zone investment, that means you're not having to pay capital gains on something. When you sell your property and then you don't do 1031 exchange, you also don't have to pay the capital gains, but you have to pay it in 5 years in the future. So it is slightly better to do a 1031 exchange from property to OZ.
Are the COVID renters moratorium affecting landlords since they are not getting the rent payments?
I think it is very hyper local and it depends on where you are. If you're in San Francisco or New York, where asset prices could fall down by 10%, imagine this. Property in New York City are falling by 10%. That's a real thing, guys. And I would never bought property in New York City last year or 5 years ago because it doesn't cash flow. If it doesn't cash flow, I can't leverage. And so in the places where I buy, which is in Kansas City and other parts of Middle America, Republican states, um, most renters are still paying. Uh, if there's moratorium that's affecting landlords, most likely what the landlords are doing, and these are mostly the mom and pop landlords, which are affected, they're getting forbearance from the banks. So the banks are understanding. The banks are directly being told by the Federal Reserve not to acquire assets. What that means is don't default on anybody. I'm not sure how long that'll last, but they are being as lenient as possible. And at that point, we'll probably see a huge amount of foreclosures. And what happens with foreclosures is people sell. When people sell, when everybody sells, prices go down.
Here's another question. So if Tesla leaves, it might be smart to consider where they may be moving to. I think so. What do you think?
Yeah, but you're probably not the first person thinking about that, and you're probably not the only. And the people who have real estate purchasing those big lots in Austin or other places have a lot of early advantage. I literally I knew a lot of people who knew where Amazon was selecting their headquarters. I know a lot, people in the know, people who are developing, they're hunting for the information all the time. This isn't illegal, guys. In stock trading, this is insider trading. In real estate, this is asymmetric information that has advantages to you. That's why I love real estate.
Do you share profit when you sell the asset?
Yes, for the most part, we sell profits when we sell the asset.
What do you think of Austin, Texas real estate?
When I think of Austin, I think it is California minus 5 years.
What is the minimum to co-invest with Tozy Capital?
It depends on the investment. I would say talk to us because we really like to create relationships with investors for the long run, which means that a lot of our investments are invested by repeat investors. So I want to make sure that people come in where they're comfortable, because takes a lot of comfort to takes a lot of trust and comfort to understand this process. Hopefully, by doing it once, you get more comfortable.
Yep. And if anyone's curious about some of the opportunities that we have, feel free to reach out to me as well. I'd love to get on a call and kind of run through the deck and learn it myself because this stuff is interesting to me as well. So what do you think of the Austin market? We answered that one. Are there any other cities besides Kansas City that you like? I'm curious to know.
There's a lot of cities I like. I don't like St. Louis. I don't like Cleveland. I love Columbus. I like Orlando. I like Jacksonville. Tampa's pretty good. Miami sucks. Essentially where public money is coming, where essentially a lot of money is coming, that's ready. Like if you heard this is a buzz city, you're ready too late. Yeah, it's like any stocks, right? It's you gotta look at the fundamentals. You gotta look at the math. These trends do not change significantly from year to year. They are 5, 10, 20-year trends in population growth, job growth, and economic decisions that the local municipality makes to encourage these growth.
What is the best way to ensure that our CPAs are up to date and take full advantage of the tax code?
Be proactive for your taxes. I think if you're not being proactive, if you're not attending sessions like this, if you're not attending sessions with CPAs, figure out how to reduce your tax liability. Most CPAs should be on top of the game, but there's a 900-page stimulus bill coming down the pipe with a ton of provisions that will be written in the IRS that they're going to have to study for 2-3 months to learn about. I've had to tell my CPA a lot of stuff proactively that he didn't know, that I've learned because I'm very self-interested in these strategies for myself. Be as self-interested as paying as little taxes as you are about earning as much money. You probably spend a lot of time trying to figure out how to make more money, spend an equal amount of time figuring out how to keep more of your money. You don't have to spend an equal amount of time. You can spend a fraction of your time and you can have a ton of ROI for it.
I definitely agree with that. I'm more interested in how I can reduce my taxes. Where do I start? Is real estate a good way to go?
Real estate is one of the best ways to go with reducing taxes. But the concept of investing in real estate is an investment. If you invest in assets, there are typically significant tax breaks to help you reduce your taxable income. If you do not invest, if you have no capital, there's not as much benefit. So there are other ways to do it. There's land conservation easements, there's oil and gas. These are other ways to reduce your taxable income, but they still require money to invest in. So it takes money to make money, essentially.
Do you have your own management company?
Property management company is probably what you're asking. I do not have my own property management company. I do have an asset manager. I run a capital private equity company and a real estate investment company. And we outsource a lot of our management to local experts because I don't think that's a cost center we want to hold on to.
So this is from Doris here. If the origin of the monetary source is pulled from from a standard IRA, then the money would normally be taxed at my tax rate. Therefore, passive income.
If it's coming from an IRA, it's already tax sheltered. So it won't necessarily retain all the same benefits from a loss perspective, but you're not really having any of the negative impact on the positive.
Do you like Arizona as a market to invest in?
I love Arizona. I made 20 offers this year in Phoenix.
Wow.
And the surrounding area, and I've lost in every one of them by at least 30%. It is
Wow.
crazy hot in there, not just temperature rise, but market rise.
Yeah.
I did not want to make less than 10% return on my money. I'm still trying to make money.
So Doris says, oops, let's try this again. The property for 1031 exchange must be a rental property, i.e., or in other words, not a primary residence.
I'm missing half the question, probably.
The property for a tenant must be a rental property. Okay, let's circle back. If Doris could
So a
help.
1031 exchange can only be done using income producing property. If you're renting out if you move from your house and you're selling it, and you want a 1031 exchange from it, you have to rent it out for likely a year before you can 1031 exchange. If you don't rent it out for a year, you have your section 120 exclusion that essentially allows you to take $250,000 of capital gains off. So almost as good, probably as good.
So here's a question here. Do you recommend buying a property in SF since prices have dropped a little bit?
That's a good question. I am not in the business of speculation. I think San Francisco has a lot of long-term chronic problems from a fiscal perspective. But also, if I'm speculating on San Francisco, I'd rather be speculating on San Francisco companies. I really rather be speculating on Bay Area companies. That's more liquid and that has strong correlation to the valuation of these properties. If more companies are leaving San Francisco real estate will get cheaper. If more companies go to San Francisco, they will get more expensive. But I'd rather just buy a basket of tech stocks that essentially emulate the same thing.
Yep. Do you own Section 8 properties?
I do. I have several Section 8 properties in California, and I love Section 8 properties. I love my Section 8 tenants. They pay very small rents relative to the market rents. The government pays the rest, and the government is a always on time taxpayer, rent payer, unlike my tenants.
So we got a lot more questions here. So is it too late to invest in opportunity zones this year?
It is not too late. We have one this year, but the timeline here would be if you sold stocks, October 5th, 2019 to now, you can invest it for the end of the year to defer your capital gains. Feel free to reach out to me, to follow up on that.
Do you need to be an accredited investor to invest into an opportunity zone? Not necessarily if you go through syndication.
Yeah, it depends on the syndication, of course. There's 506C and 506B. C means accredited only. B means allowable for some sophisticated investors.
How old is 2Z Capital?
2Z Capital is 2 years old, although I've been investing for 12 years and have been syndicating for longer than 2Z Capital.
Is Research Triangle Park in Raleigh, North Carolina, a good market?
It's a great market. I've invested in there myself. I think it's a little pricey right now.
What would happen to those strategies if Congress ever to pass a wealth tax to be paid every year?
Wealth tax it means that you can identify the value of an asset. That will be administratively very costly, and I would imagine there will be lots of loopholes to then shield and hide the value of an asset.
Let's see. We have some questions over here. Is cash flow the only factor that decides whether you like a city? Are there any other considerations?
I think you want to make sure you got growth happening. Now, the growth isn't really to account for appreciation. It's to account for any headwinds that might happen. You don't want more headwinds than you care to have. You can buy a bad deal in a good place and still make it a good deal. It's hard to buy a good deal in a bad place and make it a good deal. So I try to buy a good deal in a good place.
Yeah, I'm starting to see your formal analysis for commercial real estate. The way you blend it, you're looking for these tailwinds that are very localized, and in stocks is a little bit different. But anyways, another question from Liz here. If money for investment is coming from an IRA, does it have to be in an LLC first?
No, it depends on how your custodian is holding it. If it's usually held in the custodian account, which doesn't need to be an LLC.
Okay, then last question here. If I do not have extra funds for investments or just not interested in doing so, does your business provide a service where I could call before selling my home to ensure that I'm completing the sale in a way that I maximize my tax breaks?
We have definitely helped a few folks around tax advice and investment advice. So happy to talk about it. It really depends on your circumstances, but happy to give free advice as well. I love talking about this stuff, as you can see. I try to figure out all different types of strategies. I probably thought about almost everything that you've looked online, and I can tell you the pros and cons of each.
I like that. I like that. Okay, last question. Can you please share any unpleasant stories on Section 8?
I think any workforce housing tenants is going to be tricky. And I'm not sure if it's Section 8 or not Section 8. I don't remember exactly. But most of my properties have been C-class properties, which means not the best properties. Not the best properties means not the best tenants. Not the best tenants means more cash flow. So more A-class properties, and someone like myself, I'm probably a low headache tenant. If I was renting, I would probably be renting at 5 times the value of what someone else might be renting. But I probably am not a complainer, and I probably will pay on time. That's typically my profile. I've had such a tenant where they had a rabbit and I had to evict them, not because of the rabbit, because they had a few other stuff, but I just remember that the rabbit was in point of contention. And I swore after that I would never buy in California again, which I have not.
Okay, all right, we do have another question. Last one, okay, guys, and then I'll tell you where you guys could reach out to us. It is not capital gain from the whole year that can be invested now, just the last quarter investment gains.
For a opportunity zone, a capital gain, typically you will have 180 days to then invest it after the sale of your stock. In December 31st, you have a special provision where if you sold it all the way back from October 5th or earlier this year or 8 months ago, you can invest it before the end of the year and defer those capital gains.
Okay, awesome. All right, guys, it's top of the hour. I'd like to say, Ang, thank you so much tonight for your time, man. Like even the guy here that's doing the MC stuff, I'm learning a lot. So thank you so much. Everyone else, thank you tonight for coming out as well. I do want to announce that tomorrow we're going to be hosting another event. This was kind of like a last minute on my end, but we're going to be presenting on Grand Royale, which is one of the projects that Ang has. So if you want to get into like, I guess, more of the granular commercial real estate projects, that's what we're going to be talking about tomorrow, same time, 6 p.m. So anyone's welcome to come out. As for that last question, where can we reach you? You can either reach out to me or Ang directly. Either way works. If you reach out to me, you and I could hop on a call and we go through the decks and we'll learn commercial real estate together. I'll make it fun.
And tomorrow's presentation will be about an asset that has both the tax-free nature of depreciation as well as the tax elimination from tender exchange.
Yeah. No, I really do that. If you guys check out these presentations, we could eventually learn to see how Ang is purchasing his commercial real estate and what particular, I guess, edge for that local pocket he's looking for. So I'm looking forward to many, many more events, guys, with Ang. Some questions. Okay, guys, what is the Zoom link for tomorrow's event? I posted it up on Meetup already. So however you guys got in here today, it should be on the Meetup page. Thank you, Ang. The last comment caught my attention. Kay, as always, terrific. Thank you, Doris. Great presentation. Thank you, everyone. So let's call it a night. And yeah, you guys could bother me, or well, maybe not Ang, but you guys could bother me anytime. Thank you,
Thanks,
Ang.
guys. Appreciate it.
Hey, thanks a lot, man. All right. Have a good one.